Sujit, in a recent Lex column, you audaciously criticized the most fundamental security valuation approach, the discounted cash flow analysis. What inspired you to this apostasy?
Yes, so my specific grievance dealt with the creation of the financial projections which go into the DCF. And specifically what I was wondering is why should we trust a methodology that relies on projections that go out 5 years, 10 years, when we can barely predict 1 or 2 years? And so if we go out that many years and we're off, it's going to affect a large portion of the value because there's something called terminal value, which is the value that comes after the projection period. So if you're off in year 3, it's going to affect year 5, and the whole thing is going to be thrown off.
And all of us who've worked as analysts are familiar with this phenomenon of 3% growth last year, so we just plug in 3% on to the infinite horizon.
That's right. And so we think revenues and cash will just steadily go up.
Right.
But if you did this in 2006, no one's DCF would have accounted for the financial crisis.
Right.
And
so everybody's DCF was wrong.
yes. And so if we can't account for things like that and companies are not doing that, how can we rely on this to predict value today? We can still use DCF, but we should also look at comparable company trading multiples, transaction multiples.
Surely trading, and we all do that too, right? We say the peer companies are worth 17 times earnings, so this company must be worth 17 times earnings. But nothing says that the multiples that markets assign have to be correct.
That's exactly right, and those multiples will change over time. 1 year they're this, next year they're that, so that has its flaws too. So really, it's triangulating between all three of these and understanding the flaws and benefits from
So you're just a valuation skeptic, basically. We're feeling around in the dark, trying to.
Valuation is a construct. It's not a science.
Not a science, indeed. So you've had a lot of response to your column.
Yes, people have been very passionate. Everyone learned this in school, so has an opinion. A lot of people have talked about discount rates, and so the Lex column.
That's sort of the classic criticism that the Lex column often makes, right? Which is that you change the discount rate on your future cash flows from 6.5 to 7, and the value of your security changes by 30% or whatever it is.
Yeah, that's true. Although I would assert that discount rates have, for your typical mature company, a pretty tight range, say from 9% to 11% or some band like that. So I think there's more variability with the actual projections 5 and 10 years out, and so that I think is a sensitivity that should be more paid attention to.
So are we leading the abolish the DCF analysis movement, Sujit? Do these things have any value whatsoever?
They absolutely do, but we should know what the limitations are and take any evaluation with the requisite grains of salt.